Awesome. Welcome, Jacqueline from Ghana. Awesome. So, thank you again, everyone, for joining us, and welcome to the inaugural Enterprise Development Workshop Series. Feel free to continue to introduce yourself in the chat with tell us where you're located, your current position, and the name of your business. And I will go ahead and read some out for us. Welcome, Emanuela from Ghana.
Thank you.
Oh, welcome, Kwame. We're so excited to have you here joining us from Kenya. And welcome, Stanley from Zambia. Please feel free to turn on your cameras. We will be starting very shortly. Okay, so good morning and good afternoon. My name is Alima Williams, and I will be your facilitator today. I'm a junior research associate here at Foreign Africa. And just again, thank you all for joining us for the first session of the Enterprise Development Workshop Series. So, the Enterprise Development Workshop Series is a practical capacity building platform that's designed to equip entrepreneurs, startup founders, and students with applicable business development tools and strategies. So, the first session is titled Smart Budgets for Startups Building a Strong Financial Foundation, and it focuses on helping participants develop a practical budgeting skills to support financial stability, informed decision making, and long term enterprise sustainability. So, I am excited to introduce the first speaker of our Enterprise Development Workshop Series, Mr. Stephen Nyadyea. So, Stephen Nyadyea is a finance and strategy professional with over a decade of experience across banking, insurance, pensions, and higher education finance. He's a managing partner at Vecta Advisory and senior finance and operations officer at Ashesi University or EduCollab. He specializes in financial management and reporting, taxation, and fiscal policy analysis, advising SMEs, nonprofits, and institutional clients across Ghana's public and private sector. He holds an MBA in accounting from the University of Cape Coast and is an associate member of the Institute of Chartered Accountants in Ghana. So again, thank you so much for joining us, Stephen. We look forward to your presentation. So now I would like to invite the founder of Foreign Africa, Mr. Alorm, to tell us a little bit more about Foreign Africa and speak to their current objectives.
Thank you, Alima, for the introduction, and good afternoon, everyone from Accra. I welcome all of you to our first session of what will become a series of conversations around entrepreneurship and business development on the continent. I will briefly speak about our organization, Foreign Africa, what it represents, and the kind of impact we want to make, and obviously the contribution we want to make to building a conscious business ecosystem across the continent. So for us, we are a non-profit organization working across foreign policy, entrepreneurial diplomacy, and enterprise development. And part of the things we do is pretty straightforward. We just to provide practical economic opportunities for young Africans, startups, women-led businesses, and social innovators. At Foreign Africa, there's quite a number of things that we do, and most importantly, research, strategic partnerships, and policy engagement are the center of the things that we do because we want to connect our entrepreneurs to knowledge, networks, markets, and opportunities. Because we place a lot of emphasis, very strong emphasis on regional integration and youth empowerment. And one of our programs, which is the Enterprise Development Workshop Series, is key to the work we do over here because we intend to provide practical learning and also provide platforms for our entrepreneurs, students, women-led businesses, social innovators, early-stage enterprises to get some opportunity to learn in an environment that has been built to ensure that that capacity that they need for business strategy, budgeting, management, and the entire enterprise development arc from business initiation to job creation, we ensure that we are that organization that is working to support these entities across the continent. So I want to welcome all of you in what I believe would become an enduring relationship that we are building with businesses across the continent. Do feel at home, and I encourage you to participate fully in this first session. Thank you very much, and you're welcome. Alima, thank you so much for giving me the opportunity.
Yes, thank you so much, Alarm. So, before we get started, I just wanted to make a few quick reminders. So, kindly stay muted throughout the presentation unless explicitly asked to mute yourself. And please feel free to ask your questions in the chat throughout the presentation. We want this to be as interactive as possible. So, now I would like to hand the presentation over to our lovely speaker, Mr. Stephen Nyadiaya.
Okay, thank you very much, Alima and the team at Foreign Africa for extending the invitation to me to speak at today's session. And thank you so much, everybody, for joining us today. I hope that by the end of this session, it will be worth your while. I'm going to share my screen, and then we can kickstart. A second. Okay, can everybody see my screen?
Yes.
Okay, all right. So just like indicated by Alima and Elon just now, what we're looking at today is smart budgeting, targeting SMEs and early start businesses or early stage businesses. The reason is that you may be an innovator, you may be an entrepreneur, but it doesn't necessarily mean you have the required knowledge in terms of finance to be able to have a comfortable tap over your financial operations. And so what we're trying to do is to, at the end of this session, provide you with the tools and techniques that would help you to have a hang over that. And so we will try to be interactive, even though it's virtual, and we'll share knowledge. I've seen some of my former colleagues and some former students, colleagues on the course. I'm sure that all of us will share ideas, and then at the end of the day, to be beneficial to everybody. So what are we looking at today? We'll specifically be targeting businesses that are intending to scale, those who are still at early stages trying to figure out things, and also be looking at student entrepreneurs, how we help them to manage their funds. So to do that, I'll give a brief introduction to what budgeting is, and I'll also look at strategic budgeting. We'll be looking at budget estimation and control, and then we'll focus on student budgets and students financing for small business that students come up with. And then we'll have a case study to look at, where we'll have a real case, business case. All of us will be working on it, where we break out into our breakout sessions. We'll deal with that, and then we'll return with feedback from you guys, and then we'll have a Q&A session, and then we call it a day. At the end of the session, we'll be sharing some budgeting templates and some ERPs for finance. I mean, there's an accounting, a free accounting ERP that I recommend for my clients. And so at least the desktop version is free. So at the end of the session, I'm going to recommend that you go download it, and at least it will help you to clean up your financial operations. Okay. So the first is financing options and capital structure. So if you set out to establish a business, there is a way you want to fund it, and that's very primary and basic. There's a way you want to fund it. Either you are funding it from your savings, you are raising funds from the stock market, you are partnering with other people who are funding as a partnership business, or you are going for credit, right? And so we'll be looking at what is the optimum level you can operate at. And this is specifically for everybody, but more specifically for companies who are sole proprietorships who are intending to scale. And if you want to scale from sole proprietorship, are you going for partnership where you are able to leverage on the funds that other partners will bring in to scale? Or are you going to raise an IPO? Or are you going to rely on donors, that is free grants? Or you want to approach the banks and other credit lending facilities to help you? So this is the first thing you want to look at. So what is capital? Capital is everything you are going to be using to fund your business. It includes financial bit, which is financial capital. It also includes human capital and other forms of capital. But for the purpose of today's session, we will be focusing on financial capital. That is all the funds that will be available to your business to run with. All right. So you are either looking at equity or debt, or a combination of the two, right? And so equity is anything that is from your own pocket or your own savings, plus any profits that you would have retained from past operations, which you are willing to plow back rather than spending it on your lifestyle and other leisurely stuff, and investor capital. And let's pay attention to investor capital. Every other thing at the equity box is yours or is free money. But when you come to investor capital, investors would rather give you their money on which they are expecting interest. And then in that case, it will shift to a loan or debt, or they are giving it to you, in which case you will not pay back, but they were expecting dividends and ownership share of your firm. So if you don't want to share, if you want to be 100% owner, and you don't want to say that, okay, we are co-owners, or you don't want your stake in your business that you have formed to decrease, then you may want to be careful when you're approaching investors to give you money, which is free money, right? Which is not loan. So that's equity. And then we come to debt. Debt is loans from your banks, bonds, overdrafts, and trade credits. So you approach a bank, you said, okay, I have a net value of 50,000, but I want to scale to a 500,000 business. This is my business model. This is my cash flow projection. I want you to support me. Then the bank looks at your books and said, okay, we are convinced you have the capacity and you know, the cash flow to support your claims, and you're able to pay our loans back. Then they will advance that to you, right? Or short-term overdrafts that they will advance to you. Another form of debt is where you rely on your suppliers to, instead of paying cash for the things that, or for the wares that they give to you, you take it on credit. And then you promise them, I'll pay in 3 months, I'll pay in 6 months. That is also part of the debt arm of capital, right? So at the end of the day, what you should be looking out for is how to optimally balance these two elements of capital, right? If you're not interested in sharing your ownership rights with anybody, please don't go for investor capital, in which case they are looking for dividends and ownership share. Then if you are confident that you can pay back, you may want to look at it as a loan, right? And so you have to document that properly so that there's no confusion at any point. Okay, so this sheet is summarizing what I just said earlier, where when you are going for equity, it is from your own funds or investors who are willing to share in the business. in this case, the key advantage is that there will be no repayment obligation. There is not a loan. You're not paying back. But just like I mentioned, the key risk is that ownership will be diluted. So you're 100% shareholder. Now, if you float, so let's say that your business is worth $100,000, but you want to scale up to $200,000. Either you go for the extra 100,000 from a bank as a loan, or you float shares, or you rely on angel investors who will be willing to share your business, right? So if one investor gives you 100,000 plus, what it means is that the two of you become the only shareholders, and in that case, your ownership will be diluted from 100% sole owner to 50% shareholder, right? And so you take decisions jointly. If in any event, in any course of the business, that other person has more shares than you, in other words, they're bringing more money than you to support operations of the business. What it means is that if care is not taken, you may end up being the minority shareholder, right? So the business you have struggled to build is doing well, but you are in the minority. So you don't have the decision-making control anymore. So those are the nuances you should be considering when you are intending to scale from your sole proprietorship business, right? Another form of equity could be that you are going into a partnership deed with somebody else or another company, right? And in that case too, you're going to be sharing profits and losses, and you'll be taking decisions jointly based on the partnership deed that you have built. The second one is debt. These are borrowed funds. And the advantage is that the interest on debt is tax deductible. Right? So if you go for a loan from the bank, the interest you pay to them is tax deductible. So you'll be taken from your profit before tax is slapped on it. The only caveat is that it should not offend what we call thin capitalization rules with the tax authorities. Thin capitalization is where a company is overly funding their operations with debt because they don't want to classify them as equity upon which taxes will be paid on their dividends, right? So once it doesn't affect that rule, you have tax benefit from the interest you pay, right? But the key risk with debt is that interest payment pressure and the payment of the capital will put a lot of pressure on you if you are not sure of your cash flow situation. If you don't have consistent cash flows coming in, going for a loan from the bank, especially if it is huge, you have to be careful with it because banks will come for their money. And if you are not strong enough to be able to pay, they may put your assets on hold, liquidate it, and defray their debts and move on. It means that your business is collapsed. The other one is retained earnings. This is actually your own business. You made profits, and instead of spending it, you're putting it back in the business, right? But the key drawback is that it doesn't come in large quantities because it's just profit is not much as fresh. It shouldn't be as much as fresh capital injection, but it's your own money. The financing cost is low, and you be in good hands. So no matter how small or micro your business is, if you make profits over any period, please put some aside and reinvest it because it represents the lowest form of risk to your business. All right. So I am told that there'll be a session dedicated to this particular two slides where we are looking at financing for businesses. But I just want to give you a little teaser to that. And so when that is available, when the registrations are open for that, you are encouraged to sign up and we'll go into details than that. Okay, so we are coming to budget formulation, control, and monitoring. What we are seeking to do, by the way, do you have that? Does anybody have a question in relation to the previous slides I just shared in terms of funding options, etc.? Okay, thank you. Then we can continue. What we are seeking to do with budget formulation and control, I think is the bane of today's session indeed. We're not trying to come to tell you how to or teach you how to type figures in Excel or your ERPs or accounting software that you use, because we know you know how to do that already. But what we are seeking to do is that how does that serve your business and how does it put it in a strategic position for you to make the most returns, control your cash flows, and stay afloat as a business owner. So that's what we're seeking to do. And so we are going to be giving you some of the techniques that we have garnered from practice and consulting over the years, right? That's what we're going to be doing. And then when we finish, all of us will work on a test budget to test your understanding of the concept that we have discussed. So the first thing, and this is basically from experience, the first thing that you do when you set out to budget, I'm assuming that you already have budget, but we are just saying that it may not be serving you at optimum level. I hope that you get that clearly. It may not be serving you at optimum level. So what we are seeking to do is at the end of this session, you go back and review it based on certain frameworks that we have designed, right? So the first one I want to talk about is the 4-action framework for budgeting. And this is a framework that is designed to help owners and budget holders to think strategically about their budgets. So if you have a budget, it is not just typing your income, netting off your expenses from it, and you say that, okay, we are expected to make a profit of X amount, right? You have to think about it strategically. And to help us is this 4-action framework. And we have been using this in our practice a lot. So when you set out to budget, there are 4 things you have to keep at the back of your mind, right? The first one, we are going to be starting from the bottom. The first one, bottom left. The first one is, what am I going to eliminate completely from the budget? Okay. By all means, you should find something to eliminate, because there are when you review client budgets, obviously it's not hard to find inefficiencies in their processes and their operations. So the first thing you want to do is, what am I going to eliminate completely, right? Bring it to 0, or even delete the budget line completely. This is to identify expenses and processes, activities that add little to no strategic value to operations. It doesn't add anything. It's just nice to have, so you're having it, right? Or at the time you included it in the budget, you think it was going to serve you good, but it doesn't turn out to be so. So what we are saying is that completely eliminate that, right? The second one is to reduce. These are items that are on your budget line, which are important enough to keep instead of eliminating, but they are not as important to be spending the amount of money you're spending on them, right? So for those items, we're saying that you should reduce them. Either you are reducing them by 10%, 20%, 50%, 40%, 70%, whatever percentage works for you. So by all means, there should be something you are reducing drastically from your budget, right? As in terms of the allocations you're making to that side. Let's say, for example, you have budgeted that you're going to be using $50,000 to do marketing. And we are saying that if the return on investment for that marketing cost does not far exceed the 50,000 you have invested, then we should reduce the amount you're using for marketing. And marketing is important. You cannot eliminate it. But we are saying that if it doesn't return the best value you're expecting to help your business to grow, then you should be able to reduce it drastically, right? So that's the second one. Then the third one is up left. That is raise. So there are certain budget lines or items in your budget that you should be raising. You should be increasing the allocation you've given to that area. So if marketing is serving you right, or your ads on LinkedIn and social media, Facebook, is giving you the traction you are looking for, what we are saying is that increase the money that you have allocated. And where would you get this money from? Don't forget that you have eliminated something which is not working at all, and you've also reduced something which is working but not enough, right? So those savings you've made in those areas, we are saying that use it to raise areas that are to increase investments in activities that drive sustainable growth and give you a competitive edge over your competitors. This applies to profit-making organizations and non-profit-making organizations. In fact, one of the best ways to run a non-profit is to think about it as a profit-making organization. Put in the controls, put in the measures, tight measures that profit-making organizations put in, and then you'll be able to increase your impact numbers, right? Then the final one is there's something new you are creating in every budget cycle. So if you are not creating and investing in new opportunities and revenue streams, or capacity building for your team, you may not be able to have competitive edge over your customers, or over your competitors, right? So you should be able to invest in new opportunities, new revenue streams, new capabilities that competitors may overlook, right? You are just doing the normal stuff, but before they realize you are investing in a new product, in a new revenue stream, by the time they catch up, you are a market leader in that space, right? So at every budget cycle, you are looking at what new opportunity am I creating for my business. So that is the 4-action framework. Please pay particular attention to it because our test is going to be based on this framework, right? So there's something you're eliminating, there's something you're reducing, there's something you're eliminating because not adding any value at all. There's something you're reducing because the value is not as much as the investment you're making. There's something you are raising because it's working. And there's a new opportunity you're trying to create to get a competitive advantage in the market, right? Okay. So you have mapped up all those what you're supposed to eliminate, reduce, etc., etc. Now, what is the steps you follow? And this is very important for those who are budget holders. Maybe a finance officer or finance manager in a company, and you're the one that put together the budgets, or you're a business owner who you do not have the money to hire an accountant or finance officer yet. We are expecting that you do these things to be able to optimally manage and optimally estimate your budget figures. One of the key dangers of liquidity. And by the way, the reason why we budget, one of the reasons is, and the reason why I have to put together a good budget, reliable budget, which is realistic, is to be able to optimize your liquidity level. So if your budget is not realistic, what it means is that you may overestimate your revenues, you may underestimate your expenses, and at the end of the day, you'll be running into losses. Right? So it's important that a budget estimation is a future event, but you are doing it with systems in place to make sure that when the period is done, the deviation will be minimal as possible. Right? So this is the steps that you have to follow if you want to achieve that optimum level. The first one is we are saying that define the planning framework. So what is the budgeting about? But by the way, we don't only budget for our firms or our organizations, just the annual budget. Okay, that's not all we budget for. We also budget for programs and project specific activities, right? So we don't only budget for the organization's annual activities. If you have a project that is coming up, you have to put a budget together for it. So you have to ask yourself, what am I budgeting for? Am I budgeting for my organization for the year? Am I budgeting for a project, specific project? Or am I budgeting for capital and investment? Right? So define what you are budgeting for. What is the time frame and duration? Right? It's going to take 6 months. It's going to take 1 month. It's going to take a year. And normally your organization's budget will be yearly, right? But if it's a project, maybe the project is supposed to terminate after 6 months. Then you have to define those parameters carefully, right? Then when you have done defining those parameters, you go to the next stage. And this stage is to gather your strategic and operational inputs. What that English means is that you have a strategy that you're running for 5 years, and you have your operations to run for the year, right? Anything strategy is for the long term, and the operations is for the now. So the operations input will be how much tax is the tax authorities coming to take from me? How much would I use for salaries, my staff salaries? How much am I going to use for raw materials, those who are in manufacturing? And how much am I going to use for subscriptions for my online resources that I use? Those are operational inputs. Then strategic input will be, okay, my 5-year plan has having to build another factory or having to, build another branch, right? Or venture into other markets. How much of my budget am I going to allocate for that? So you have defined the framework for planning. You're going to gather your strategic input and operational input. That is, which of my strategy am I executing this year, right? You have that under wraps, and also how much you need to meet your day-to-day operational demands. So all of these things I'm saying, you're supposed to be writing them down. I mean, not now. We're going to be sharing the slides. But when you sit down to budget, what we are saying is that you put pen and paper or open Excel, and then you define the framework, the planning framework. Okay, strategy. you're going to be building a new factory or we're going to be opening a new branch. You put that aside and how much it will cost. And then you estimate your operational input as well, right? Okay, so you have that done. The reason this is important is that you don't want to over-focus on strategy or to the neglect of operational input. And then tax authorities will come for you. You have not budgeted for how much tax you pay, or that you are over-focusing on your operational bit, and then you are completely ignoring your strategic plan. What it means is that your business will not grow because you are not following through with your strategic plan, right? So you have that under wraps. Then we move to the next stage. At this stage, what we are doing is that you are estimating or you are thinking that you have a certain X amount of income at the end of the period, either 6 months or 1 year. You have also estimated that there will be this amount of money that will be spending at the end of the period. What we are saying is that a budget has to be researched. It's not a wish, right? Okay, last year we had $200,000, and this year, and then we spent 500,000. We spent half of that, and so we made a profit of X amount, right? So this year, okay, we should increase the revenue to 500,000. No, so it's not a guesswork. So a budget should be well researched. You see, so by well researching your budget, you look at what the market is, the size of the market you're operating in. For example, let's say that you're into delivery business. Those who use motorbikes to do deliveries and meals, to do food delivery and dispatch meals. You look at the size of the market, right? And you can see that with the regulatory authorities in each country. You look at the size of the market and you ask yourself, which size of the market am I currently operating? Right? So am I operating at 5% of the market? Am I operating at 10% of the market? Then you can safely say that, okay, because I operate at 10% of the market, I intend to increase to 15%. I put in the plans and strategies to do that. Then I can increase my profits or my revenue projections by this amount. So what we mean by validate your income and expense pipelines is that you're expecting to get money from a certain pipeline or a certain source. You're also expecting certain sources to drain money out of your pocket. Those are the expenses. You want to make sure that they are not guesswork, they are correct, right? By the way, this budget I said is supposed to be for a future period, right? But you want to make sure that whatever you are predicting is near correct when you compare the actuals to it. Those of us in grant management, you know that some of the grant covenants, what they do is that they don't accept a deviation of more than 5%, either under or over of your budget. So if you budget that you're going to spend $500,000 on a project and they give you the money to do it, they don't expect you to go over it by more than 5% or under it more than 5%. What it means is that you have to validate your income, validate your expenses, and be sure that it is what will happen, right? When you finish doing that, you move to the next stage, which is after you have validated your income and you are sure this event will happen, you want to apply external shocks to it, which means some of them may not be under your control, but you make provision for them. So the fourth is apply assumptions to it, and this is inflation, right? Inflation is going to go down or go up. Then you make adjustment to the amount you validated. Those of us in Africa, for example, most of the economies where the exchange rate against the dollar and the euro is not as stable as you would like it. We also have to watch out for the foreign exchange rates that will be applied, especially when you are having inputs imported from other countries, right? So apply assumptions to your income validation and your expense validations, right? And then when you are done, put all of them together. So all the notes you are making in your diary or on your Excel spreadsheet, you're going to put all of them together. And this is what we say we're not going to do for you because we believe you know how to do it already. We're just trying to give you the techniques to do that well. So now you go to your Excel, you open your Excel, you put okay, the first one is budget for the year ending 2026. And then you put income, grants, sales, donations, etc., etc. You validated all of that. And you also applied your assumptions in terms of expense and all that you applied to it. And then you also have your staff cost, production costs, investment, etc. So you have all of that. What we're saying is that put all of them together in an Excel sheet or in your accounting software. When you are done, what we are saying is that check the numbers or sense check the numbers. What this means is your budget is the financial blueprint of your strategy, right? And the thing about strategy is that because it's so subjective, we are not able to see if your strategy is bad or good, right? But once you translate that into a budget, it will become figures, and 1 + 1 have to be 1, right? So now we are easily able to see if your strategy is poorly conceived or is properly conceived. So sense check your budget. Let's see if it makes sense. So you have your income, you have estimated that it will be about $500,000. And then we see that your expected expenditure or estimated expenditure is $700,000. How are you going to fund the difference? Right. And by the way, this is not extreme. I've seen budgets like that, right? And then what, especially those in grants management, they'll come and say that, okay, these are budgets, we have a deficit of 200,000, so we want you to help us with it. No, that's not how you approach those who give grants to organizations. What you have to do is to balance off your budget, make sure that you are not going over it, make it make sense, and then you approach somebody that, okay, this is what I'm currently doing, but I want to scale. And so if you help me to scale, this is what will happen, right? My income will grow by 45%, and the impact I'm making will move from X amount to X amount. So your budget has to make sense. If it doesn't, you have to start the process again by gathering your input, validating, applying assumptions, and make sure that it is at a point where it's acceptable to yourself. It will help your business, it will help you to grow, and it will be acceptable to funders who are willing to either give you free money in grants or extend credit facilities to you because they trust that you're able to generate enough in revenues to pay back. Right. Okay. Now, so when you finish at the 5th stage, what we are saying is that we have put together a working budget. And if you work for an organization which is already established, it means that you're forwarding it to your supervisors, they validate it as well, and they send it to the board. The board approves it. Then it becomes an approved budget for the year, which you have to execute. Right. So in executing your budget, one of the key areas of budgeting is budgetary control. So you have done all the groundwork, you have researched, you have looked at the market, you have looked at your sales values, you compared it to previous budget, you know everything is clean, right? It balances off nicely. Now we are saying that plan is good. That plan is what you want to see at the end of the year. And the deviation shouldn't be much. So you have to make sure that you do everything humanly possible by putting in the systems and structures, the controls in place to make sure that everybody in your organization is working towards achieving those budget estimates, right? So you don't have a budget for, let me use marketing again. You have a budget for marketing and you have estimated that the budget for marketing for the year is going to be $20,000. Don't go over it because the marketing manager is pressing your neck to approve it, right? You have to explain to them that, look, we have a plan. If we go over this will affect other lines and other operations. And so everybody must stick to it. And that's what we mean by budget control. And how you control your budget is that you record the actual expenses regularly, right? It could be it can be a week, it can be monthly, it can be biannually, it can be annually. But the advice for small, micro, and medium businesses is that if you can do weekly, right? In fact, even if it is daily, do daily, right? You check your things, everything is on track, and you are clear that you are on the road or the trajectory to meeting your budget objectives. You see, so it's important you record your income and expenditure regularly. Those are the actual ones, and compare the actual budgets, compare the actual figures to the budget figures for each of the lines you have in your budget, and calculate a variance. That's the difference between the budget figures and the actual figures, right? And investigate what. So sometimes you may have all these controls in place, but some deviations will happen, right? So it is your job or the person who is managing your budget's job to investigate to see what is the cause of this, right? What is the cause of this? Is it that we have hired a new person which we have not budgeted for at the start of the year, or does it mean that the market demands for our products are increasing and so we have to increase production or marketing? So things like that. When you investigate the cost and the cost is just indiscipline on the financial side, you have to reverse it. But if the cause is maybe an opportunity you are taking advantage of, maybe by intensifying investment, then you have to readjust your budget to align with that reality. So a budget is not a fixed thing. I mean, we are not saying that. So you should, in fact, at the end of every quarter or at the end of every 6 months, for those who are having an budget, please go back and revise your budget. Because in the real world, as they say in economic classes, things are never equal in the real business world, right? So if the deviations are, investigate the cause of it. If the deviation is based on indiscipline, please cut the indiscipline out and make sure that everybody is in line. But if the deviation is because of a positive outlook, then you have to revise your budget figures to align with that budget outlook so that you can take full advantage of the market, right? Okay. Then the last thing is report the findings. Okay, so these are budget holders who are not business owners, who are reporting to the business owner or the board or the executive committee. Report the findings to them and make note on what the deviations are and explain it nicely and explain to them. If it makes sense, they'll approve it for an adjustment. If it doesn't, then they will ask you to take a corrective action. Okay. I'm just prompted. There's a question in the chat. Alima, can you please, can you please read that for us to take it before we continue?
Yes, it's from Jacqueline.
Okay.
So they said, can you share so they run a sole proprietorship and struggle to value their business because they started with personal funds. And so they were wondering if you can share a simple guide to determine the true value of their business towards external investment.
Okay. Okay. So, that's business valuation. And what I would advise is that business valuation is done by experts, other accountants or certified valuers. If you cannot hire any of them, what we look at your current earning potential. How much do you get at the end of every period, right? And then you also look at your asset register and see how much is in there. So we have three forms of asset valuation. One of the easiest is net assets, the net asset method, where you are putting together all your assets, right? And then you are going to take off all the liabilities against those assets, right? So let's say all your asset base is $1 million US, but you have a loan which you use to fund those assets, 200,000. You have another short-term credit from another place, 50,000, right? And then owner's equity, right? So owner's equity will not be taken off because you are selling for business or you're going to open up for other investors. So if you cannot hire an accountant, you can make a good guess by putting together the value of your assets, physical assets, and virtual assets, and put a price on them. I'm sure you have a price on them already, and then take the liabilities out of it. And then the difference is the net assets you have. And that's what you're going to be telling somebody the value of your business is. And then you're able to make a good estimate of how much your share prices are going to be like. But if you want to bring in other investors, I would always advise that you seek advice from accountants or proper valuers to do the valuation for you, because it's not a business valuation is a complex area in accounting. And so I believe that so that you don't shortchange yourself, that's it. I mean, if you pay some fees to an accountant to do this for you, it will save you millions rather than undervalue your business because you are trying to do it yourself. So you can have a good guess by looking at the net assets you have, but that's not the only method we have for business valuation. We also look at the share prices and then the earning potential of the business as well. So by all means, seek some professional advice from an accountant. Okay. Please, do you have any other question? Okay. I think there'll be a Q&A session as well at the end of the session, so we can deal with some of these things in detail. Okay. So the next thing we'll be looking at is liquidity management, right? And these are technical jargons in finance management. But what we are seeking to achieve is that at every point in time in your business's life or the budget cycle, you're able to meet your payment obligations as they fall due. That is the basic principle of liquidity management, right? We are trying to make sure that you have enough cash at hand or in liquid assets that can safely pay obligations when they fall due. So that when the tax authorities come, you can pay. When your supplier says, okay, the invoice is due, you can safely pay. When the staff, the end of the month is due, you can safely pay your staff without telling them that, okay, we are late on salaries this month, and so we'll pay next week or next 2 weeks, right? I mean, once you have liquidity challenges like anemia, right? So you see a normal human being is healthy, is not infected by any disease, but they don't have enough blood, right? So that is basically a business who is having a liquidity challenge. So you may go to the gym, you may be healthy, you may eat well, but once you don't have enough blood, those nutrients cannot be circulated well all across your body, right? And so we are saying that there should be a lot of liquid cash at hand for you to be able to do your business well. And to help you to do that are some um, key stuffs we want you to look at, right? So liquidity management is a concept of arranging your business operations in a way that you don't have to find yourself wanting, looking for money to sort out your short-term, especially short-term obligations, right? So the first thing we want you to pay attention to be able to avoid liquidity challenge, right, is know your cash position at all times. And so you have to be recording your transactions, right? Some entrepreneurs are so busy innovating and managing the staff and the operations of the business, and so they don't pay much attention to recording transactions. But you have to record your transactions, including even the stock you have in your warehouse, right? If you're in a restaurant business, if you're not tracking the vegetables that people are bringing to you, okay, maybe you trust your staff, right? But the point is that we want you to pay attention to all your inputs, your staff, and the sales you're making and the expenses you're making, right? So to know your cash position, you have to know how much cash you have at the bank at the end of every month or every week. Know how much extra you have to pay to another person, and also know how much somebody else is owing you that they have to pay to you, right? So to illustrate this, I owe X $5,000. My cash in my hand right now is $1,000. What it means is that if that is all I have, I cannot pay X his 5,000. I'm 4,000 short. But the point is that Y also owes me 10,000. So if you look at my cash position is supposed to be 11,000. And so I should safely be able to pay X the 5,000. But because Y did not send me my 10,000 early, now X is going to be making noise that I owe them, I don't want to pay. And then, grapevine can move faster than anything. Gossip. I mean, what I mean is gossip. And these people, they can't even pay me. And once you are going to, once that repeats a couple of times, you're going to lose credibility. People will not be willing to give you stuff on credits anymore, right? So we are saying that you should know your cash position, know how much you have to pay somebody, know how much you have in cash, and know how much somebody else owes you as well. And then when you do the simple arithmetic by adding your cash to how much cash you have with somebody and how much you have to pay, you have a clear picture of how much you have left in real terms. So to do this, you should be able to receive your money from people early, right? You should be able to receive your money from people early. So that leads us to our second point, which is match the time of inflows and outflows, right? So if I sell stuffs to somebody, I also owe somebody because I also use inputs to produce whatever it is I'm selling. What we are saying is that you should have a reasonable time frame for people who you sell stuff to or who you provide services to pay you, right? And the rule of thumb is that your receivables day time, that is how long it will take you to receive your money from somebody, it should always be shorter than how long it takes you to pay out your client. So to do this, you are going to be doing two things. The first one is to get off-takers for your services and products. Off-takers are wholesalers or retailers who come to source from you. It's like you're not telling them to come or you're not begging them. They have signed with you that every month we'll take 5,000 boxes of chocolates because you get it. So those are off-takers. You produce, they just come to take it, right? And then you have an arrangement with them at the end of 3 weeks, they give you back your money. Now, if you agree with the person who comes to buy your chocolates, 50 boxes, that is, you're going to be saving the money from them in 3 weeks. But the point is that the person you bought the cupboards and the cocoa beans from is also on your neck to take their money. The arrangement you should have with them is maybe I'll pay you in 1 month, right? So it takes longer for you to pay your debtors than it takes you to receive money from your okay, it takes you longer to pay your creditors than it takes you to receive money from your debtors. That's what I was trying to communicate. So that by the time you pay the people you buy the inputs from, you'd have had money from the persons you have sold to, and then you pay them, right? So that's a basic arrangement. Your receivables date time, that is how long it takes you to receive your money from your debtors, should always be shorter than how long it takes you to pay to your creditors. And all of this has to be an arrangement. So you get off taking agreements from those who you sell to, and they're willing to come and pay. It's not like the stocker in the warehouse. You're not going to run about looking for people to sell to, or you're providing a service and nobody is subscribing, right? So at the heart of liquidity management is your business model. You have to have a good business model that can generate enough cash and be able to pay for input as they fall due. The third one is to maintain a buffer. So you're not spending all your things, or you're not putting all of them into stock. Because stock, it takes a lot of time, or inventory. It takes a little time for you to convert that, right? Or if you're a service provider, you don't invest all that you have in cash. You don't put it in operation. There should be a little bit of cash you have left. Because I said again, in the real business sense, things are never equal, right? And so something will just happen. You didn't expect it. It wasn't part of your projections. It wasn't part of your budget, but it has happened. It's going to be affecting your business. And by all means, you have to use cash to solve it, right? So you should maintain a reasonable amount of cash, either in physical cash or an easy to convert short-term instrument, which you can go to the bank and go and liquidate, and then you can go and use it to defray whatever it is that is befalling you, right? So by all means, maintain a little bit of buffer, right? And the rule of thumb for small businesses is that at least you should have another month or so of your monthly expenditure bill as a reserve, right? So that if things go haywire, at least you have something to fall back on. Then the fourth point is the distinction between a cash problem and a profitability problem. A cash problem is when you sell to people, they didn't pay you early enough for you to be able to pay your suppliers. That's a cash problem. But a profitability problem, or on cash problem again, or your stock is in the warehouse, nobody's buying it, or your services are not being subscribed to, right? A profitability problem is a business model problem where you are not able to generate enough revenue, right, to cover for all your expenses. So at every point in time, you're making sales, right? But your expenses are outstripping your revenue. That's one, no magic of liquidity management can solve it. You have to relook at your business model, re-strategize. If it is an injection, you do it. If it is a strategic partner with another business person, you do it for them to help you. If it is technical knowledge you have to seek on how to run efficiently, you do it. And then you can be able to reverse that. But if it's a liquidity issue, you can just revise your relationship with your vendors and your suppliers, and then that'll be good. So there should be a clear distinction between that. If you're having an issue, check yourself if it is a profitability issue or just a cash issue which you can solve, right, by adjusting our operations properly. Then the last one on this point is look at what we call a cash conversion cycle, right? What that means simply in simple terms is how long does it take for me to put money in an investment and get the money back? You see, I'll take it again. So your cash conversion cycle is, for example, you bought things from China, right? And you use $5,000 to buy baby feeding bottles to come and sell in the Ghanaian market or in the Nairobi market, right? What we are asking you is, if you invest that money in those bottles today, how long before you get it back? That's what we are talking about. And the rule of thumb is that it should be short. The shorter, the better. If it takes, if you and another person are in a business competition, and it's taking you 2 months to convert back your money that you invested into the baby bottles into cash, and it's taking them 3 weeks, what do you think will happen? What will happen is that they'll finish selling their bottles, get the money, go and buy another one again, right? Come and sell. By the time they finish selling the second one, you are now trying to conclude sales of the first stock you have taken. So at the end of the day, they'll be making more profit than you. They'll be able to outcompete you in the market. They'll stifle you in the market and make sure you die out, right? So your business model should be designed in a way that your cash conversion cycle is quick and fast enough. I mean, that's how you'll be able to survive, right? And one of the advantages of a shorter cash conversion cycle, or in another simple term, how long it takes you to get your money back, is that you have cash at all times to be able to explore other business or investment opportunities because you have cash. It's not locked up in stock anywhere, right? So those are things you have to pay attention to. I'm going to be recapping this quickly. Know your cash position. That's how much cash you have or can convert to cash at every point in time. You should match out when you will be getting money and when money will be going. There should be an agreement between them, right? Or you have to design a way of making sure that it is in a way that you don't have yourself begging people to pay you to pay other people. They should pay it before you pay the people, right? Then maintain a liquidity buffer. Also distinguish between what problem you're having. Is it a cash problem or a profitability problem? If it's a profitability problem, then you probably have to look at your business model again. And then, of course, know how quickly you're able to convert. So for the fifth point, for example, you can use this to assess your ventures. If you want to invest in anything, ask yourself, how quick before I get my money back, right? And in established businesses, we call it payback period. If you want to invest in a building project or a factory, the question you're asking is how soon before the factory is able to pay back the investment you have made in it, right? But for trading and all that, we can use cash conversion cycle. Okay. Okay. So for those of you who are already established business owners, I've seen the metrics. I've seen that you are joining us from about 11 countries across the most predominantly from Africa and other parts of the world. And also about 65% of you are already established business owners. But I've also been advised that we have some student entrepreneurs amongst us. So kindly bear with me for those of you who are already established business owners. Kindly bear with us to quickly look at budgeting techniques for college entrepreneurs as well. And we're going to be doing that in less than 5 minutes. And then we can move on to our case for the day. And then we'll break out into our breakout rooms and have quick discussions and come back with feedback. And then we can call it a day. So for student entrepreneurs, why budgeting matters more when you have less. So the point is that you don't have the liberty that an established business owner has because your money is small. And for most of you, what you're actually using to do this business is savings you're supposed to have spent, which your guardian or your parent or some project you work on had given to you, or some scholarship you've gotten had given to you. But the point is that you remember that when you put 2 seeds of corn on the ground, it will germinate and it will bring you some more dividends. So you decided to put that small money into some level of economic activity, right? And so you put it on the soil by investing it. It germinated. And then after some 2 weeks, you've started gaining some dividends. Those of you in Ghana, for example, some of our colleagues, in the university, we're doing ice cream and we call it sobolo. I don't know how it's called at other places. They do all of this thing. They put it in their freezers and they're selling it to us. And we're buying it, right? So for students and entrepreneurs, it serves you 2 purposes. If you're a student and you want to venture into some level of economic activity on campus or in your immediate community, there are 2 things you are virtually doing. What you are doing is that you're increasing your disposable income, right? You're putting small into something and you're getting more revenue on top of it. You take the profit, you support yourself, you put it back again, you're getting more on it. The second thing it does to you is that it is training your muscles for full-time entrepreneurship journey when you finish school, right? And so for people like you, the simpler you put things, the better. And you should be recording your things because you don't have the room to make mistakes. If you have I'm going to be using the US dollar because of our international audience. If you have about $500 and you want to invest it into something on campus and it didn't go well, what will happen? Actually, it means that the opportunity is gone, right? But if it's a business owner who has enough, they can quickly put another one again in another place and survive. But you don't have that luxury. So that is why it is important that you do your things very strictly because your margin of error is very small. So the first point is that your margin of error is very small. So your financial discipline must be sharper. So write your things down. You have a diary, you have exercise books, or you have an Excel on your laptop. Write it down. Just write it down. Anything you have done. If it is something you have invested in or something you have sold to somebody, just write it down, right? And don't mix personal income with your business income. Because you have sold things to your colleagues, maybe you have gone to buy for the ladies, you're going to buy maybe cosmetics and you're selling it to your colleagues, and they have bought it. Then you think that you have enough money and then you're spending it. No. If you're putting it in your business, then it has to be business money, right? It has to be business money. Otherwise, by the time you finish, you won't have anything to go and buy cosmetics again to come and sell at a profit, right? Then the third point is that profit and cash flow are not the same thing, and don't confuse them, right? Let me give you an illustration. So you have a $500. You went to the market, you bought cosmetics, you came to your hostel or your hall, and you sold it to your colleagues. And when you finish selling it, you got $700 in total. The $700 is not profit. That is your cash that have come in. Out of that 700, 500 is supposed to be your capital. So the profit you have made on that 700 is 200. And so if for anything at all, you can spend some of that 200 and put some back to add back to the 500, and then you're making progress. But if the 700 comes and you think it's profit, you finish spending it, and then your business is gone with it, right? So you should distinguish between profit and cash flow. So not everything that comes in is profit. The profit is the difference between what you have invested and how much comes back in sales. And the fourth one and most important one is keep your budget simple. It can be an exercise book on Excel. Keep it simple. Don't disturb yourself with this whole complex budgeting templates that established organizations should use. And it's important for them to use it because the nuances are many. But for you, keep it simple because you are venturing into this venture. You also have your exams to pass, right? So you have to keep it simple as much as possible. All right. Then we're also going to look at the 4 budget lines you should maintain. Just I said, keep it simple. Have revenue, have fixed costs. Fixed costs is what you have to spend on because you're in operations. And the variable cost is the increment in the cost as a result of the increment in your sales value, right? Because of time, I'm going to run through this quickly, but we'll share the slide so you can take a look at it later. And then the next one is net profit. So the difference between you have a revenue, you've less the fixed cost and variable cost from it. Whatever is remaining is your net position or net profit. Right, okay. We are trying hard to beat the time. I thought I would be faster than this. Unfortunately, I'm not able to. So yeah, so that is about the student budgeting. So keep it simple, keep it clean, distinguish between what is profit and what is cash flow. Don't eat the seed. Make sure that you are putting the seed aside. Otherwise, your business will go with it, right? And you have to be taking the lessons alongside because you need it when you finish school. You want to venture into full-time entrepreneurship. Okay. So we are going to be looking at a case where we are going to be evaluating the budget of a company called ABC Digital Solutions Limited. And so we have a short explainer to whatever it is that their budget is. We'll share the budget. I think Alima, my colleague, was going to share it in the chat for you. They're going to share the budget with you, and then she'll play a video explainer about the budget and the business model of this company. What we are asking you to do is to pay attention to the video, look at the budget, and see what is wrong with that budget. and how you can resolve it, right? What we have been doing today is to be able to spot even those mistakes in your own budget and take corrective action. So to be sure that you're able to do that, we want you to look at the budget that Halima is going to share in the chat, open it on your desktop, look at it, but there'll be a video as well, explainer, 2-minute video explainer for you to see what was wrong with it. It will be explained in the video. And then you apply the the 4 action framework we spoke about, where you're reducing something, you're eliminating something, you're creating or you're raising something. But for this particular business, let me give you a news flash. It's over bloated budget. Their expenditure far outstrip their revenues. So what we are seeking to do is to reduce it as much as we can. So there are certain things you should eliminate, and there are other things that you shouldn't eliminate but reduce it drastically. The point is that at the end of the day, you should be able to break even, or you should be able to help them to break even. So I'm going to I'm going to stop sharing. I'll come back to this again and with concluding remarks, but I'm going to stop sharing at this point and ask my very honorable facilitator, Miss Alima, to share the Excel on this company and also play the video for us to have a look at.
Of course. The ABC budget activity is linked in the chat, and I will now be sharing the video.
Welcome to this Vecta Advisory Explainer. Today, we're doing a total financial autopsy on ABC Digital Solutions. Look at this massive negative number, a $329,000 net loss. How'd that happen? So how did this startup bleed so much cash? Let's dive into the whiteboard documents and see. They projected $340,000 in revenue, but actually burned through an insane $669,000. And honestly, that revenue was basically an illusion, just wild optimistic projections with zero signed contracts. They banked on unproven software sales, completely ignoring weak market demand and serious customer churn. But guys, the real crime scene is the expense sheet. It shows zero baseline financial discipline. Get this, personnel costs alone were $212,000, totally unsustainable for a pre-revenue startup. We're talking huge CEO salaries, pointless executive assistants, and unearned bonuses while they were actively bleeding cash. Then there's the vanity trap. Their luxury office overhead is just mind-blowing for a bootstrapped company. Instead of building a product, they dumped cash into premium rent, fancy renovations, and luxury furniture. And here's a classic startup killer, premature scaling. They bloated marketing and HR before making a dime. Rather than keeping things lean, they hoarded unused software and threw money at expensive IT consultants. But the craziest line item, dropping $55,000 on a luxury SUV, just absolutely ridiculous. Plus, their sloppy cash management wasted another $29,000 on bank penalties and expensive short-term loans. So what's the bottom line? This budget isn't just bad, it's a literal fast track to bankruptcy. All right, now it's time for the Vecta Advisory Challenge. It's your turn to step in and fix this. You'll use the 4-action framework. Reconstruct this entire budget by eliminating, reducing, raising, and creating. Your mission, review these fatal flaws, apply the framework to cut the bloat, and present your solution. So, grab a whiteboard marker. How will you save ABC from ruin? Let's get to work.
Okay, so that is the explainer. And so what you are basically doing is that you look at the budget that we've shared in the link. You're going to be shared into breakout rooms. You are supposed to discuss this and quickly fix so the Excel sheet has a column, right? Action. The column called action. And all you have to do is to type in, if it is reduce, say reduce. If it is eliminate, say eliminate. And then the column in blue would be reducing by itself or changing, right? So you don't have to type anything there. Just eliminate or reduce, and then the figures will change by themselves. And so at the end of the day, we want to see if you're able to help them to break even at least, right? So there'll be 3 breakout rooms. We need 3 volunteers who will be leaders of those breakout rooms. Or you can volunteer yourself, or somebody can volunteer you. And then you go do your work quickly within 5 minutes, and then you come back, and then you come and report to us what you have done. Right? Okay. Yes, please.
Hello, guys. Alima, Augustine, Hildana, can you guys hear me?
Yes, ma'am.
I think this is supposed to be a room, so you guys are supposed to be engaging.
Yeah, we can hear you.
You guys should be speaking and discussing your budgets. Okay. You have to do the activity. So work with the team in the room. Yes.
If someone wants to lead the session, I can share my screen and show the Excel sheet and type in what we want to reduce or increase.
Guys, you have less than 5 minutes to finish this up. So you should be getting ready because you do a presentation after.
Okay, everyone. Can you see my screen? Yes, no? Oh. Can you hear me? I'm sorry. Can anyone hear me?
I can hear you.
Oh, okay. Okay, so just not getting
You're
responses.
loud and clear.
Okay, thank you.
Can you hear me?
Yes?
Sorry, my mic was not working, so I had to log back in.
Okay. So looking at this budget, is there anything that we want to reduce? Maybe the number of executive assistants. I mean, it is a small company. Or maybe the CEO salary, since they haven't started generating revenue yet. Anything? Anyone?
Perhaps the CEO salary?
Okay. And then what are we supposed to reduce? Okay.
Yeah.
Okay, so net loss is slightly decreasing. What about the non-essential hires?
That one we can eliminate. We can eliminate not essential hires.
Okay.
Boko pala nusa. Masaba andir ma amur babao. Amnu andir mo boko pa nusa. Boko pra? Oi, tumpa lo she pluma.
Okay. So luxury overhead, so the driver and support staff of, or what about luxury furnishing? Furnishing, would we want to reduce that maybe?
So that will reduce,
Um,
yeah, reduce that.
Yeah, it's a small company.
yeah,
I don't
I
know.
mean, yeah, $4,000 for a chair, I think not. Yeah, so maybe we should reduce the office snacks and catering because I don't know. I do think it's important to eat though, but I think since it is excessive discretionary spending, we can reduce it maybe.
Yeah.
And then we're also allowed to raise things. Um, oh, you have influencer marketing. But if you see something you want to raise, decrease, or eliminate, just feel free to shout it out. Yeah.
We could try reducing the luxury SUV acquisition, I think, around operation
Yes.
and technology.
Yes.
Yes, the luxury
So
SUV we have to reduce it to maybe
yes.
a second-hand car.
Yes.
The Toyota Corolla. Corolla. Sorry.
Yes, Corollas are reliable, you know? It's a great vehicle to start off with.
But
Um,
the staff bonus, I think we can eliminate because we are barely getting any income. So why do you give staff bonus? You give bonus when you have earned enough. So I
yeah.
think we can eliminate the staff bonuses.
Thank you,
Okay.
Kennel.
Also,
Mhm.
I think around location, there was like luxury, something about I think it's number two, on number two, above marketing and branding.
Mm-hmm.
Their luxury overhead, I think.
Luxury overhead. Oh,
Or
yes, yes, yes. The drivers and support
yeah,
staff.
at this point,
Yep.
I'm just looking for luxury.
Yeah. So maybe do we want to eliminate or reduce?
Probably eliminate. I mean,
Okay. And we're still looking at a net loss of $177,000 or $177,000. But we've got this. Uh, Penalties and late fees, weak financial discipline. Anyone see anything else?
weak financial discipline. Like we can work on that.
So how do we, I guess the question is, how do we want to address this do we want to eliminate it, reduce, raise, create?
I mean, eliminate. But I don't know how we're doing that, but eliminate.
The penalties and late fees. I mean, someone has to put things on a calendar,
Yeah.
maybe, at least for the late fees.
High
Um,
high transportation costs. Like,
yeah, where's,
do we reduce that? It's under SUV, the SUV acquisition.
oh yeah, I think we can definitely reduce that, especially with fuel maintenance. Although, I mean, with fuel prices rising right now,
Yeah.
um, we'll see how we can. Okay, 165,000. Abdul Aziz, do you have any recommendations? Or Nana? Or Najat? Or Gafaru?
I think we can consider the marketing and branding section. There are a lot of overheads there we can eliminate. Social media ads, branded merchandise, corporate events, billboards, influencer marketing. So we
I think I
can we
messed up.
can we can eliminate quite a number of expenses there. For instance, the influencer marketing, I don't think we cannot keep that and keep billboards, and then we'll keep social media ads as well. So we could
Yeah.
retain the billboards, reduce the billboards, take out the social media ads, and then retain the influencer marketing.
Yes. Okay. I think I accidentally just messed that up really quickly. I'm going to reshare my screen. Also, Rita, how are we looking on time?
Marketing team.
Alima, did you say something?
Yes, I was asking how are we
Okay.
looking on time?
So,
You were asking for what, please?
driver and support
What were you
staff.
asking for, please? I didn't hear that.
Oh,
Reduce
how
or
we
eliminate.
were looking on time
Okay.
and when
Not so
everyone will
much,
be.
but
Okay, then
given that
staff
the
bonuses.
rooms just started engaging, we'll give them about 3 minutes more to wrap up.
Okay, then let's move
Okay.
to administration.
Sounds good. Thank you. Would anyone else be able to share their screen? I don't know what's going on with my screen. Okay, there's a problem with the formula. Okay. See. Your type shows your type. Oh no, this is not working at all.
Should we eliminate
I sent an announcement that we have 2 minutes
Okay.
more.
And
Okay.
then
Did you get it?
okay, then we have
I did not see anything on my end. I think it's because we're in the main session, maybe, or maybe I just overlooked it.
think it's maybe
Then vanity
I think it's
events.
because you're in the main
So
session.
eliminate it, right? Since the other marketing.
Eliminate, reduce, create. Okay, I guess while I figure out what's going on my end, it's not letting me access any other budget documents at all. So we said we wanted to, nothing is working. I'll just put it over here. So we wanted to reduce reduce the CEO salary. We should probably, oh my goodness, this is not working for me at all. Logic test value of true if false. Da, da, da. Okay, I don't know what's going on. Yeah, okay. I'd say I agree with Augustine. We should definitely reduce the social media ads. Probably decrease below. Sorry?
That's great.
Yeah, but
Awesome. Yeah. And then I think we should also completely eliminate the vanity focused corporate events. So that saves us $28,000. If we reduce the brand and merchandise, then we'll save probably $9,000. So that puts us at like $37,000 that's saved in addition to, I think it was like 165,000 that we had here. Sorry about the technical difficulties. I do not know what is going on with my computer.
Sorry?
Oh, don't say it.
We're back to plenary now.
Okay,
Yeah.
awesome. Okay.
I mean, I think we have it figured out.
Yeah.
I
Okay.
agree.
So welcome back from your breakout discussions. How did you see it? Was it difficult? Was it easy?
Exciting.
It was easy.
Okay.
Yeah, it was quite interesting.
Okay.
Yeah, it was interesting.
Okay, all right. So it's that simple. I mean, what you can do is to go and have a look at your budget like that, and then apply the same mechanisms, and then you'll be able to, flesh it out. So therefore, we have 3 volunteers quickly, 1 minute each, to give us a general overview of what they have done in their rooms, and then I will hand over to Alima. So room 1, who is volunteering, please?
Okay, so if you have let's Emanuela for room 1.
Okay.
So in summary, we reduce the operational cost in terms of the payment of the CEO right down to all the staffing. And then for expenses in terms of the infrastructure, we reduced majority of the cost, and then we eliminated is that our sheet, please?
Yes, that's our sheet.
Okay, great. We eliminated our office snack completely from the administrative cost, went down to marketing. We reduced majority of the things, and then we took out the corporate event cost. Right down to operations and technology, we reduced majority of those items too. We looked at the finance cost, the loan we cannot take out, so we reduced that as well. Bank charges we reduced because we reduced the loan amount. And then the penalties, we make sure that we'll be paying on time to avoid that kind of expense. And then in summary, we reduced our cost or our budget from $329,000 to $57,500.
And by the way, this was a loss of almost 330,000. But then now we are making profits of 57,000, right? So that's a lot of progress. Thank you
Yes,
very much,
please.
Emanuela, and those in our group for a
Yay.
fantastic job.
Thank you.
Okay, so we move to another person.
Sure.
Room
Thank you.
2. Who is volunteering for us?
Hi, my name is Jackie. I was in room 2. Well, so we did a general reduction, but then I would like to point out that even before we went down, we looked at the income budget and we realized that for miscellaneous income, there was no defined revenue source, sorry. So we thought that if we could look at a reduction in the miscellaneous income, then push rather the subscription income high, because you realize it says customer churn ignored, which means that there's a possibility that there are some customers that need to be followed through with. So we decided that we'll try and then increase the subscription to 200,000 or more, and then reduce miscellaneous to 5,000 or even less. And then for expenses, we thought to eliminate staff bonuses, reduce the CEO salaries, remove drivers because they are not essential hires, but then maintain the support staff, because to follow up for the core business of the for the company, to follow up on customers, you need some support staff for operations. So maybe calls to help the marketing team and all that. And then we thought that the marketing team's budget, even though it's on the high side, maintain the budget for them, but then slash down the HR's budget by about 50%. Most of the things are really reduction, so I'll just leave these ones here.
Okay, thank you very much. That was interesting, and I'm happy that you went to look at the income side and try to rationalize it before you move on. That was good. So who is doing for the other breakout room? By the way, please be looking out for we have a business budget that is built and it's divided into months, right? We have that for you. We're going to be sharing with you. So be looking out for that in the chat. Halima, who is going to share that as well. So you can use it for your budgets if you don't have some yet, right? Okay, please, the last person, the last group, please.
I can go ahead and share my screen if someone wants to explain what we decided to do.
Okay, so for us, I think we reduced majority of the items on the expenditure side. Really see clearly, but then yes, we reduced the CEO's salary. We also, I think, eliminated the office renovation. We eliminated the non-essentials for so we did a lot of eliminations and reductions. We decided to swap the luxurious cars for Toyota Corolla, more affordable. Yes, and then yeah, that is a summary of what we did. Thank you.
And then I believe
yes.
Sorry.
So thank you very much. Thank you very much. You have done well. You have turned the negative to 61,000 profits. That's good. That's very good. That's very interesting. Okay. All right. So thank you very much for participating in the exercise. Some closing remarks. I think we are a little bit behind time. I hope you guys forgive us. but I hope that is worth your while. The bottom line is that you're able to do the right thing when you go back to your business, and we wish you all the best. I will hand over to, okay, by the way, questions. Do you have any questions you want to ask? Any clarifications? Something is not really clear you want to,
Okay,
Feel
so
free
my
to
question
raise.
is with the
okay. Okay, please go ahead.
okay, so my question was with the when we did the budget, I think my group we eliminated the bonuses. Would that affect staff performance when you take out benefits that are due them? How do you handle such instances for a startup?
Okay. Please, I hope you can hear me.
Yes, please.
So, in fact, bonuses are tied to performance. And usually, no matter how good your performance is, so there are two conditions for bonuses. The first one is that your performance must be good, right? As a unit or as a team. And then the second condition is that your organization should be able to make profit, right? So even though your performance is good, if the organization does not make enough profits, then for that year, there will be no bonuses because you already have negative. Just like we see in ABC Digital, they had a negative of about 330,000 US dollars. So you can't be paying bonuses on top of that, even though the performance of your staff may be good. So then it's incumbent on you to explain to them that, okay, we are not in a good place now. We hope that we raise our performance even more for next year so we can get bonuses. But the rule of thumb is that before somebody gets a bonus, their performance must be good. And that performance must translate into the company making some profits, right? But if the figures are negative, no matter how good your performance is, we will thank you and then hope that we make profit the next year and then we pay you.
Well noted. Thank you very
Okay.
much.
No problem. Any more questions, please? Okay.
Caleb, I saw your hand was up. Do you have a question?
Yeah, I have
Okay,
a
go ahead.
question. So my question was maybe as someone with the irregular income, maybe as maybe a freelancer, sometimes you find that payment, they come maybe some days or months later, but you have expenses like rent and subscriptions which are due maybe every month. How can I manage my cash flow so that I don't run out of money between the payments?
Okay. So, Caleb, right? Caleb, thank you very much for that question. I think that along the line, when we're dealing with the strategies to manage your cash flow, we mentioned that you maintain some buffers or reserves. You remember that, right?
Yeah.
So when your income is irregular, but when it comes, when it comes, don't dispense all of them in the period in which they come, because you know that they will not be coming probably the next month, right?
Sure.
So still you have to spread them. So for this month, you are lucky you get your gig and then you work on it, and then the money comes in.
Yeah.
If you use all of that in this month and next month you don't have payment, then the whole of the next month you cannot pay your subscriptions and data and those things, right? So you have to keep maintain some level. For example, if I'm hoping that by two months you get another money. So what our advice is that at every point in time you should have a month extra reserve, which can safely cater for at least your fiscals for the succeeding month, right? So regardless of how tempting it is, when you get money, you want to spend it, please put aside some reserve for the next month where you may not get income. If you get income, you build that reserve even more. But if you don't get it, then it comes in handy to help you at that time. Okay.
Thank you.
Okay. Elizabeth, please go ahead.
Thank you very much for the opportunity. So I am a startup, and then I invest my any little amount of money that I get into my business. I want to know if there is a specific layout to budget. Because normally I just write whatever I invest into my business in a book, but then I want to use an Excel sheet now.
Okay.
And I want to know if there is any structure that I can use for this.
Okay. So thank you very much. And I
And
wish you
please,
well.
and
Okay.
please, and again,
Okay.
since I don't have like a specific source of income, how do I include my annual budget in whatever I do? Because for me, it's just all about, okay, I have one CD, I'm investing into this, and I don't have enough to say that this is my annual budget for maybe my activities.
Okay. So I have some preliminary question before I answer the question. So what do you mainly invest in? What is the thing that you invest in mainly? And how much revenue does it give you after you invested? I mean, you don't have to
Okay,
mention the
so
figures, but I mean, just a general idea what you are doing.
okay, so I bid, and
Okay.
I am it's a startup, so I don't really have customers, but most of the time, I get people to patronize me through recommendation and a little posting that I have been doing on my status and all of that. But then, because that is actually my personal savings and all of that, any amount that I get, I'm like, okay, today I'm broke. Let me just spend what I have. Yes.
Oh, okay. Okay. So how you're able to estimate your annual income is you look at how much you're able to get on average every month and multiply it by 12, right? And you also want to include seasonality. For example, at Easter times, people will buy more. At Valentine's, people will buy more. At Christmas, people will buy more, right? For their loved ones. So I believe that you can just multiply by 12 and consider seasonalities as well. But when you get income, please don't spend all. That's all. So you would have to, for example, when you do the biddings, you have to go and buy input from the market, right? And you have to buy other things. You have to buy some other like the threads and all those things. So by all means, those ones have to be put aside. That's what I was saying, that cash flow is not the same as profit. So when you spend about 100 Ghana cedis to go and buy the input and you do the work and you got 300, what it means is your profit is 200 cedis. So by all means, you have the right to use the 100 to sort things out, but you can add the 100 back to your capital and grow it as much as you can, right? And the point also is that there will be a point where you seek for help. You get what I'm saying? So there are a lot of other people, institutions that are willing to give you training for your business and also give you some seed capital, right? So we can find out right now in the age of technology and AI. I mean, you can just find that those information or available opportunities for startups like you, and you can take advantage of it. I think Mastercard has some opportunities like that, and they also work with other organizations to do that. So you can just be scanning the opportunities in the air. I think you can follow up for Foreign Africa as well. I mean, this enterprise development workshop is in series. So there'll be a point where they'll be advising you as to what you can plug into opportunities to scale. I mean, to scale your business, right? But the point is that keep writing what you're writing. We put some templates in the chat, but I don't know if you need that now because it's for a little bit more established businesses, right? But you can just maintain a clean Excel template, or even in your diary, writing everything you're getting and how much it costs you to do your product. I hope that helps
All
a
right.
bit.
Thank you very much. Yes, it does.
Okay.
Thank you so much. So this concludes our Q&A sections, and I would like to ask all the participants to turn on their cameras so that we can take a quick group photo, please. It will only take a couple of minutes. Yes, sir. Thank you.
Great session.
Awesome.
Okay.
Okay. I see more faces.
Maybe you have to stop sharing. Am I still sharing? Okay.
Okay, awesome. Maybe a few more cameras, please.
Some
Few
of us look
more.
like lightning struck us, so we can.
You all look amazing. I don't know what you're talking about. Just few more. Oh, awesome, awesome, awesome. Okay, okay. I am going to go ahead. I will say three, two, one, cheese. So please work with me. So three, two, one, cheese. And I have to take a few more. So just keep smiling, keep smiling, keep smiling. Amazing. Last one, last one. Okay, ready? Three, two, one, smile.
Cheese.
Yes, you all look amazing. Thank you so much. I really appreciate this. So before we officially conclude, I want you all to mark your calendars because we are just getting started. So our next session is titled, I'm pulling this up now. Um, one quick second. So many screens. Yes. So thank you so much. So our next session is titled Funding Your Startup Grants, Debt, Equity, and Beyond. It takes place on the 26th of June at 12 p.m. GMT. So we look forward to seeing you there. This is one that you will not want to miss. We'll be going even deeper. And if today was any indication, it's going to be outstanding. And so details on how to register will be shared via email. So stay tuned. And before we close, I would like to ask that, or kindly request that you all fill out the feedback form or the evaluation form. This will probably take maybe 2 minutes to complete. And so your input directly shapes the future of the series. So every response matters, and you can find the link in the chat. And briefly, while you are filling out that form, Rita from Foreign Africa has a brief announcement. Rita, are you ready?
Yes, Alima, thank you so much for that. Can you hear me?
Yes, ma'am.
Okay, so I'd like to thank Stephen very much for the insightful and practical session. And to all our participants, we hope you found it very valuable and you're leaving with tools that you can immediately apply to your businesses. So if you would like to get personalized support on your business budget or your organization's financial planning or anything related to your enterprise, if you need any enterprise related guidance, you can book a one-on-one session with us at Foreign Africa to engage with experts like Stephen and other experts in key areas that you need guidance on. So consultation sessions are available and at a specially discounted rate of $50 exclusively for you, our startup community. So to book a session, kindly send an email to what's displayed on your screen, and we will follow through and ensure that we schedule that call with you and book the appointment for you as well. We would send this flyer as well and more information about that via email so that you are able to engage with us. Thank you, Alima.
Thank you. So on behalf of everyone who made today possible, thank you so much for being here. Your time is valuable, and the energy and engagement that you all brought to the session truly made it worthwhile. And we are especially grateful for Stephen for taking time to share his resources and valuable insight with us. This is exactly the kind of community that drives real growth, and we're proud to be building it together through the Enterprise Business Development Workshop Series here at Foreign Africa. So we hope that you're walking away with ideas, insight, and connections that you can put to work starting today, not even tomorrow. So thank you again, and we will see you all at the next session. Have a good one.
Bye.
Thank you.
Thank you very much.
Thank you.
Thank you so much. Bye, everyone.
Thank you.
Bye.
Thank you. Bye.
Okay. I'm going to go ahead and end the session now. Okay, have a good one, everyone.
All right.
Thank you, Alima.